Welcome back to Small Cap Big Ideas. Great to have you here with us. We have our next fund manager here in studio with us, Simon Conn from Investors Mutual. Simon, welcome. So good to have you here.
Thanks a lot.
What's the attraction to small caps?
Yeah, look, I mean, small caps is really interesting because it's such a diverse opportunity set. So, a portfolio manager like myself can build a portfolio that's, quite different to anyone else in the market. And so different managers will deliver portfolios with quite different characteristics. But the exciting part about this market, into the market, is it's quite diverse. You see a lot of new opportunities. The companies at this end of the market are quite vibrant and change their nature. And so it's really a very dynamic part of the market.
And so what are the hallmarks then of an investable small cap for Investors Mutual?
Yeah, so look, at Investors Mutual, we've been going just over 23 years, and we look for quality companies. So we're looking for businesses that have a competitive advantage, so some sort of economic moat, or that are businesses that are sort of one and two in their market. We look for businesses that have recurring, predictable earnings streams, that have got a good management team, solid balance sheet, and are trading at a reasonable valuation. So at the end of the day, we're a value manager. We're looking to own stocks that we think are trading below our assessment of their valuation.
Okay, so with the economic snapback, the prospect of rising interest rates, is it generally a good time to be investing in small caps? I mean, especially at that value end?
Yeah, look, I think we can find some opportunities at this end of the market, but one of the ones that really stands out to us is a company such as Propac, given the valuation is so compelling. But look, the market's it's been volatile, but it has had a good recovery since COVID, and a lot of stocks are looking pretty fully priced. But you can find pockets of value and opportunities in the market still. Okay,
so if we're in an environment of rising interest rates, what's a characteristic that a small cap sort of needs to possess?
Yeah, look, I think it's about that competitive advantage and having the ability to price their outcome, price their products, and give them some influence over their margins. Obviously, we're in an environment now where cost pressures are rising, and we've seen that across the board. And so we want companies that have a leadership position in their industry and their ability to move some of those cost pressures on to their customers and then to sustain their margins. So really a competitive advantage is really important in this environment.
Mm-hmm. And we're also able, and companies are able to borrow at ultra low rates as well. So when it comes to business confidence and spending on CapEx or M&A, I mean, is that something that is a positive in your view at Investors Mutual?
Yeah, absolutely. I mean, at this end of the market, because of the fragmented nature of some industries, there is good opportunities for mergers and acquisitions. And, we think, as you've mentioned, balance sheets are quite strong coming out of COVID. Interest rates are low, and that it gives companies the capacity to borrow money to make quite accretive acquisitions if their balance sheets are in good nick and the acquisition makes sense.
Okay, I think you gave it away. However, when it comes to the company we're going to be introducing, what does it really have going for it right now, given all of what we've just discussed, the potential for rising rates, the potential for rising input costs as well?
Yeah, look, I think, Propac is a company we like quite a lot because it has that characteristic of being a number two player in an industry which has got a long fragmented tail, but a market leader in Amcor. And Propac is sort of the number two player in this flexible sector of the market. So flexibles packaging is not a well-known category of the market, but it's consumed every day of the week. So it's your chip wrappers, your Peter's ice cream wrappers, your Arnott's biscuit wrappers. So it's used by consumers every day really to transport company food and a lot of industrial goods to the consumer or to industry. So it's used to a range of categories across the economy, and it's an industry where it's a very recurring, predictable earnings stream because a lot of these products are used by households every day of the week. So it makes the business very resilient.
Okay. So resilient, strong balance sheet. Let's learn a little bit more about Pro-Pac Packaging, a company perhaps you've never heard of.
Chances are you've held a Pro-Pac product or a product that's touched a Pro-Pac sometime in the past week. From popcorn bags to meat trays, soap pumps or PPE, Propac manufactures and distributes flexible, industrial and rigid packaging to blue chips and SMEs across Australia and New Zealand. Now, packaging may not be the sexiest of businesses, generally speaking, but throw in COVID, the shift to e-commerce, supply chains and the need to innovate, and Propac's got it in the bag. Propac was transforming pre-COVID and it continued investing in strategic projects throughout the pandemic, exiting less profitable businesses, consolidating in manufacturing footprint and acquiring Supreme Packaging in Victoria. Propac posted statutory profit after tax of $6.2 million on underlying profit before tax of $11.6 million, up 33%. Revenue in the first half was down 6.6%. Chief Executive Tim Welsh is calling financial year 21 a year of consolidation, building on the progress made in 2020. He joined the company in May 2019 after more than a decade at PPG Industries, which included stints as Vice President Australia and New Zealand and Managing Director.
Well, we have joining us now Propac CEO Tim Welsh. He's joining us from Melbourne. Welcome to the program. Great to have you here with us. Listen, you said there that it's a year of consolidation in 2021. What does that actually mean, Tim?
Well, good morning, Nadine. Thanks for having me. This year very much has been a year of consolidation in the sense that the business made a number of fairly large acquisitions in 2017. And I started with the company approximately 2 years ago. And through this time, we've been really focused on integrating those acquisitions, optimising our portfolio to ensure that we're focusing on those higher value segments and to really make sure we're extracting maximum efficiencies across the company. This really included the consolidation of our manufacturing footprint, where we made a decision to close one of our larger extrusion facilities in Sydney and recombine that back into our existing footprint in other southern states.
Now, let's backtrack just a little bit because COVID was quite kind to Pro-Pac packaging. So talk to us about some of the business dynamics that existed through the past year, and I suppose as well, how many of those, at least the positive ones, do you anticipate will continue?
It was a very interesting year for our customers and for consumers. We had certain segments that performed particularly well. The agricultural sectors had a very good year. The FMCG market has performed well, and I guess to the contrary, we saw hospitality suffer fairly significantly through the pandemic. The company did do very well out of the increased consumption of PPE and products like hand sanitizer, which we've all consumed to a great extent over the last year. So I'd say it's been on balance, a fairly year of ups and downs, but overall the momentum's been quite strong, and we believe that with some of the supply issues that we're all witnessing at the moment in the global lack of shipping containers and so forth, will provide a greater proposition for our customers to onshore a lot more manufacturing, which is really pleasing to see.
Tim, I think that's one of the things that we sort of found interesting with the stock is that this trend to reshoring, with supply chains not being as predictable as maybe the last 5 years, there seems to have been a real trend to having a reputable, dynamic, small local supplier. Can you just talk to that trend and maybe some of the the revenue gains you got in your core business in the half were on the back of some of those theme playing out?
Yeah, thanks, Simon. So you're 100% right. With many of the brand owners now, there's really two things at play. One is the customer base is really looking for an alternate second supplier. They don't want to have all their eggs in one basket. So that is really starting to shift the opportunities for the company. We're investing considerably behind capacity and capability to support those opportunities. And in addition, with the global shipping challenges that we've all heard of recently, there are a lot more customers wanting to onshore and ensure that we can continue to supply those customers and not have interruptions to their supply chains. So after many years of Australia, seeing products moving offshore, we're seeing a lot more interest of onshoring as a result, and we're really excited by the opportunities that are coming.
That's really interesting because I had thought that perhaps supply chains would be impacting Propac potentially negatively. So just to clarify, how much are you importing, or is it just the input that you're importing? And on that front, aren't rising input costs a concern?
Yeah, it's a good point, Nadine. So more than 2/3 of our business is really locally manufactured. There is an exposure to imported products through our distribution business. But one of the things that we are being particularly good at in our manufacturing business is managing the input costs of resin which is sourced both locally and from overseas. And that diversification and management has gone particularly well for the company, and we've been well set to support customers. One thing we have done in the last 6 months is taken preemptive actions around some of those short supply challenges globally, and have increased our inventories responsibly to ensure that we don't run out of stock. So we're well positioned to continue to supply customers, and through the pricing mechanisms we have with our customers, we have the opportunity to apply rise and fall measures to ensure any cost changes are either passed on or cost benefits are also passed on to our customers.
Tim, I think one of the other interesting things about the nature of the flexibles market in Australia is that you do have this strong number 2 position, and you are sort of seen as a nimble supplier who's very responsive to customer needs. And there's also a long tail of smaller flexible manufacturers in the country. I mean, you operate through 18 sites, and so that gives you, if you're able to execute an acquisition in the future, you've got the balance sheet capacity with your net debt at about 1.1 times net debt to EBITDA, and the sites that you can make an acquisition which actually could be quite accretive for earnings and quite positive for shareholders. Can you just talk about that opportunity?
Yeah, that's absolutely right, Simon. So the year of consolidation really has been about further improving our balance sheet position and the quality of earnings that we have in the company. We have, as I mentioned before, closed one of our facilities in Sydney, which is expected to deliver a $7 million EBITDA improvement to the company. That, along with the recent acquisition of Supreme Packaging, we've been able to continue to extract those efficiencies and improve the balance sheet position. So we're well set up to make some acquisitions. There are a long tail of fragmented participants in our market, and we believe we are well positioned to make suitable and appropriate acquisitions in the future.
Simon, were you interested in Propac pre-COVID, or is this something that's come as a result particularly of the gains that have been made? Because it sounds as if the company's been actually undergoing a transformation for a number of years.
Yeah, look, Propac, as you said, has been listed for a long time. It was predominantly an industrial distribution business with a smaller flexibles business. But when they started acquiring companies in the flexible sector to build that capability out, that was what attracted us to the company. And so we were invested prior to COVID. Obviously, the stock, like a lot of shares, was very volatile through that period, and used as an opportunity to buy more shares through their weakness. And I think the thing that people didn't realise was the strength of the cash flows that the business would generate, given its everyday nature of the operations and the eating from home, the supermarket trend, the hand sanitizer. That's all benefited this reshoring phenomenon. That's all benefited Propac. And so we saw in 2020, very strong cash flows out of the business, and that's put the balance sheet in a really strong position now to build the business, drive the business forward. We've had a new management team with Tim and Iona as CFO. And I think one of the other things that we've always been really liked about the business is a really well-credentialed chairman. So Jonathan Ling is the chairman, has been for about 18 months to 2 years. And I think that really sits the business up well. I mean, having been invested in many companies over the times, really experienced chairman who's been there and done it before, really adds a lot of credence and to the thesis, and also acts as a great foil for the CEO and CFO, just to give that hand of experience to say, I've done this before, I understand how we do these M&A transactions or plant consolidation sites, how an ERP program will run, and just to be able to give that guidance to management is a really strong benefit for the company.
Correct me if I'm wrong, he came from GUD Holdings, did he?
Yes, Jonathan Ling was previously, many years ago, worked at Visy Recycling.
Okay.
And then ran Fletcher Building for a period of time. And then at GUD, he came in and ran the business for a period of time when it was selling some non-core businesses and consolidating its position in the automotive industrial segment of the market, and then retired about 2 or 3 years ago.
All right. And to Simon's point, Tim, when it comes to the transformation that's ongoing, a lot of what we're hearing about now, I guess, in relation to supply chain is actually the technology that can be employed and deployed within an organization to manage your deliveries externally and internally. Can you talk us through, I guess, how technology, or if there's a technological program underway at Propac to sort of manage that better?
Absolutely. Every day we're thinking about the future needs of not only our customers, but also what it will take to improve the sustainability and the growth of our business. And one of the major investments we've made in the last 12 months has been in extrusion technology, which reduces energy consumption, increases our ability to consume more recycled content, which will set us up exceptionally well for the emerging transition towards greater use of recycled content within plastic packaging. So every step of the way, we're looking at making investments in new technology that will service our needs into the future.
There's a question that has come in from Julie, so I might turn to you, Simon, on this one. I mean, in terms of ESG, you're investing in a packaging company. Do you put an ESG filter over your investments at Investors Mutual? And if so, I mean, I would presume Propac meets it. Yes,
look, clearly it's an issue. The drive for increasing recyclability of product. I mean, we look at it on a holistic basis. I mean, the problem really is how do you get product from the manufacturer to the consumer, whether it's in industry or in the home. And so really, lightweight plastic is a very energy efficient form of packaging and of transporting that product from source to consumer. The key is really increasing recyclability. And so we're quite attracted to Propac because of the investments they're making, really position themselves as a differentiator to their competitors and the ability to use recycled product. What they're doing with the railway sleepers is a really exciting initiative where they take second-hand plastic packaging and turn them into railway sleepers, which is a really innovative solution, and we think really gives the company a big tick in terms of the ability to recycle all of the packaging that we produce in Australia. And the circular economy is a growing theme, and we've seen this with Pact, we've seen this with Amcor, and also with Propac, companies that are making that investment to give a solution, provide a solution to the community to be able to recycle our waste and give it a further useful life is really important going forward.
Tim, I couldn't help but notice when I was doing my research that it appears as if e-commerce is also part of the offering at Pro-Pac Packaging. So does that speak to the fact that you're also dealing with some smaller companies, some SMEs here in Australia? And what's the strategy there?
That's correct, Nadine. So a large part of our customer base are small to medium enterprises. So we always will establish our business to service them the way that they want to be serviced. And so we deal with anything from large global corporations down to someone that might own the local corner store. So having the ability to interact with them in the most efficient and offer the best customer experience is critical to the company. So as we move forward, not only will we be investing in technology to produce more advanced products, consume more recycled content, we'll also be investing in our digital capabilities to improve that customer experience.
That ticks a box for you at Investors Mutual. I mean, everything now is a digital business.
Yeah, clearly, the industrial distribution business and the packaging side of the business, have to be able to interact with the company in a digital manner. And so the big ERP system that they're putting in at the moment is part of that program of ongoing investment.
Simon, are dividends important in investing in small caps?
Yeah, we think so. We've been able to generate strong returns from our investments over 23 years, and all our funds have always paid a distribution to their unit holders, and that's come from harvesting the dividends that the companies we own pay shares. The companies we own shares in pay dividends, and Propac is a very strong cash generative business, as I mentioned. It has a lot of franking credits, and it has the ability to pay dividends. Recommenced the dividend payments last year. And we look going forward as the earnings grow, we think they can continue to grow that dividend stream, which, in our current estimates, puts the stock next year on a 5% fully franked yield, which we think is very attractive, given interest rates are so low. And the strong balance sheet the business has, we think that's a really good return.
This one is for you. It's coming from the audience, so we're trying to get to some audience Q&A that's coming in. And if you're in the audience and would like to submit a question, you can do so on the right-hand panel of your screen, and we are obviously vetting some of these questions as well. But asking Tim for just a bit of a summary of how you see the competitive moats in the business.
Yeah, this is a very important question for our business. So you'll note that we have conducted a portfolio review over the last year, Nadine, and that was really centered around ensuring that we were focusing our efforts in market segments that were highly engineered, highly customized, whether it's through printing and decorative means or engineering films and packaging solutions for customers' bespoke needs. So, our preference is to operate in that space. The commodity packaging area has a very low competitive moat. So you will have noticed that some of our revenues have, declined a little over the last few years, but that's been very intentional on our part to ensure that we're operating in those high value spaces where we do have a competitive advantage, and our ongoing investment in local manufacturing capability will continue to ensure that competitive moat remains in place.
Doesn't raise any red flags if you're doing your work on a business, you see revenue pulling back. It's all about the earnings story.
Absolutely, Nadine. I think it's about the quality of the business. And what we've seen with Tim and the management team is they're building a better quality business. So a lot of the deal they did with Tama last year, a lot of the shedding of the higher, some of the revenue was really at the lower quality end of the earnings stream. And so really what the business has been doing is positioning itself where it can add more value and a more defensible, much stronger market position, as Tim's been talking to, which makes the business more resilient going forward.
And Tim, nothing is without its risks. It all sounds like it's going very well at Pro-Pac packaging, but where are the challenges?
Well, I think there's some industry challenges afoot, Nadine. As Simon mentioned before, I think there are obviously some structural issues within the flexible and plastic packaging markets inherently that I think as a country we are dealing with particularly well now. It has taken some time for that momentum to shift, but when those structural issues start to become resolved, Propac packaging is in a really good position, both from its local manufacturing capabilities, its investment in innovative and best of class equipment, and we've spent a lot of time investing in developing an innovation culture within the company, and supported by the implementation of a new business-wide ERP system. We're well set up to ensure that we can access those sustainable opportunities, the circular economy work that's so important to the industry. So, one of the major activities that the industry and Propac will be a part of this is closing the loop and making sure that everyone plays a role, and Propac will certainly be at the forefront of playing an important role in the circular economy moving forward.
What else is a risk for the company, Simon, as an investor, from an investment point of view?
Look, I think resin prices are always a big focus, which is why Tim and the management team focus so much on managing that input cost. They have been volatile. We've seen the oil price trading up, so management of that is obviously a key risk. Obviously maintaining uptime in the plants, and this massive move that they had with closing the Chester Hill facility has been a huge disruption to the business. Overlaid with everything that's gone with COVID, it's not been an easy project. I know Tim's been working largely, and apparently, unfortunately, from Victoria. So that's been a challenge, but it all seems on track. So look, it's been a big year for Propac. But I think once they've completed this Chester Hill transition, which they look like they're on track for, positions the business very well going forward. And obviously, it's a fairly resilient form of consumer product. So it's a fairly predictable type of business. I suppose the other risk always is a rapid trend to going more offshore. But given what's happened with COVID and supply chains, and the customer base that Tim's talking to are increasingly demanding more of a nimble solution. The Cummins muesli bars, a lot of the innovation comes with the packaging, and also the trend to the circular economy. Really, I think positions Propac quite well, because the old days where we just source cheap stuff from overseas is not going to work going forward. In that the government and the Unilevers, the Arnott's of the world are wanting their packaging to come from a more thoughtful source and to use more recycled content, which really means closed loop, which really means Australian source product. Yeah,
it is that virtuous cycle, because if they're going to meet their ESG principles, it's a good selling point.
And you've seen all the supermarkets are on board with this. All the Coke, all the big manufacturers of food and industrial products are increasingly signing up to this. It's a global trend which Australia's catching up to very quickly. I think our Prime Minister went to the UN a couple of years ago and talked up to the importance of the circular economy. I mean, the climate change debate gets a lot of focus, but I think the government has to be applauded. They've done a lot of work around the circular economy and closing the loop. And We can't simply export our waste to China anymore or continue to bury it in a hole. The more product that we produce, we should be reusing it where we can. And I think that's really the investments that Tim and the team have been making that really attract us to the business.
Yeah, and Tim, I mean, I think that it appeals to many Australians, many investors, the thought of having more manufacturing onshore. But the reason a lot of it was sourced from China, of course, is that it's cheap. It was cheaper to do. So how do you manage those costs? I mean, how are you finding people? How, especially in this day and age when COVID has also led to, closed borders?
Yeah, you're 100% correct. There has been a trend historically to move more product offshore, but I guess what we've noticed in the last few years is that with new technology coming on board, the gap between manufacturing costs in Australia versus those costs overseas have shifted quite significantly, and the gap between low-cost countries and Australia from a labour point of view has closed because a lot of the equipment that we produce nowadays is highly automated and highly efficient, and the labour cost is a much smaller overall component of the product cost. So we're in a position where we can compete on a global scale. The investments we've made have set us up well for that, and as a passionate Australian running a manufacturing company, I'm very optimistic that Australia's got a bright future in being able to produce globally known and high quality products at a very competitive price.
And one of our viewers is asking, can you tell us who your major customers are? He thinks it's a bit difficult to find on your website.
Yeah, it's somewhat challenging. So we have a customer list of more than 20,000, so it's quite a diverse customer base, but I can point to some well-known brands that you might be familiar with. So whether it's Snack Brands Australia, the Thins and Samboy potato chips, Freedom Foods that produce breakfast cereals and snacking products, whether it's some of the contract manufacturers that produce pharmaceuticals and wellbeing products like Baxter Laboratories. We supply Toyota with cardboard packaging. Many of the well-known Australian wineries, like the Rathbone Group, that produce Mount Lange and Yering Station wines here in Australia. That's just to name a few. But Simon mentioned before, Peter's Ice Cream, Arnott's. The list goes on, but we're very proud to be supporting those businesses.
Great. This is a question from Joshua. Joshua, I'm going to paraphrase a little bit, but Simon, his point is that the share price has performed pretty poorly over the past 5 years. Mm-hmm. So, I mean, that's obviously where you're talking about finding value in a mm-hmm. company. Where do you see as the key catalyst to push that share price higher? Yeah,
I think maybe Propac's a bit of a share price is a product of its history. I mean, it was a series of acquisitions made quite a few years ago. And I think looking at the share price, people might misunderstand and not appreciate the change in the nature of the business. I mean, the old Pro-Pac, as it was listed many years ago, was purely an industrial distribution business. And it's this movement into the flexible space that we find so attractive. And that's the earnings growth that's coming from that division, which is really driving the share price, driving the earnings, and we think will drive the share price going forward. So because it's, obviously it's traded down, people look at the share price and go, well, it's, obviously there's something wrong with the business. But if you lift the hood and look at the management team and the business underlying it, we think there's a really good, solid little industrial business in that generates a lot of cash. You can look at the cash the business generated going back 12 months. And the valuation, because of that, I think is quite compelling. I mean, if it makes $15 million, which is current consensus and our estimates, market cap today is 150 million, so it's on 10 times, which is very cheap in a market where the average industrial multiple is more like 20 times. And going forward next year with the Chester Hill consolidation coming through, we have profits growing quite significantly, so it's on a P of less than 10 times FY22, with a growing dividend stream as well. As I mentioned, it's more than a 5% fully franked yield. I mean, that screams a lot of value in a market that looks pretty full. And then you've got growth on top of that through potential opportunities to acquire further businesses utilising their balance sheet strength. So we think it looks really cheap. And obviously sometimes people look at the share price and they don't want to buy stocks that have had a patchy track record over 5 years. But if you look over the last 12 months, the share price has performed very well. And I really think that's a product of the current management team and the strategy playing out. And we think there's only a small part of that re-rating that's happened. I think it's a good future for this business.
And Simon, what time frame should investors generally be speaking of when looking at small caps specifically? I mean, would you have an average time of holding for some of these in the portfolio?
Look, absolutely. I mean, given the volatility in the share market, I mean, share prices trade up and down, as we saw yesterday, by quite big percentages just on an even day. So really, an investor today has to take a 3 to 5 year view of any share price, of any share they buy, and really, it's about owning good quality businesses that will grow their earnings through time, and in time, if the earnings grow, the share price will appreciate, provided that starting valuation is reasonable. So, that's really our whole thesis. Trying to pick the day-to-day movements of the share market is a bug's game, to be honest. I mean, that's just trading. We're really trying to invest. So we're trying to buy good quality businesses that can grow their earnings and pay you a dividend over the next 3 to 5 years. And that has to be at a minimum. Growth
plus dividends. Now, Tim, just to wrap it up with you, Pro-Pac Packaging CEO, if Simon's talking about a 3 to 5 year time frame, what do you think the business looks like in 3 to 5 years?
Well, I think in 3 to 5 years we will have completed a fairly substantial consolidation of our manufacturing footprint. We'll be optimising the earnings of the business through the investments that we've made. We see that there's great opportunities to expand our consumption of recycled material in the company. We see ourselves being a leader in that space, being the largest producer of polyethylene films in Australia. We have a product stream that is highly compatible with mechanical recycling. So we have a big passion around that subject. The company, back when it acquired integrated packaging back in 2017, aimed to achieve an EBITDA in pre-AASB numbers of around 45 million. Our short-term goal over the next few years is to realign with that original goal and continue to grow through both organic and inorganic means. I think we're well set up to do that with the investments we've made.
And the balance sheet to support it, Simon.
Absolutely, indeed.
All right. Well, listen, Tim Welsh, Pro-Pac Packaging CEO, thank you so much for joining us from Melbourne. We'll look forward to seeing you in Sydney next time, perhaps. And of course, Simon Conn from Investors Mutual. Thanks for sharing your big idea with us.
Thanks, Nadine.